Hi, everyone. How are my trading warrior brothers and sisters today? Hello, Brock and Richard. Welcome to F.A.C.E. Gaurav, how are you? Gore, how are you? Hugo, Marco. Thanks for joining us today. The metals are on the move, so let's take a look. Gold's finally coming out of here. I was wondering what was taking it so long. This pullback looks pretty orderly now. Silver's been outperforming, and I still don't think the yen has bottomed. So, yields and gold, while yields are dropping, the PM should do better. They're finally doing that. Hi, Laura. How are you? Monica, how's it going? So until we get this bottom in the end, I think it's okay to be long precious metals. It's going to be interesting to see if we get this third drive. Almost looks like it's setting up in TLT for the NFP. Maybe we get a weaker than expected number and we get one more push up here. S&Ps have tried for new highs, didn't quite make it yesterday. I will say this on the S&Ps, under yesterday's low at 43.73, be careful. And this is the first time it's made an attempt without making a new high. No, really, it's the second time. This was a new high last week. And while all this is going on, we still have NASDAQ not making new highs. Really, it's kind of a great exercise in fibs, right? So I thought this changed the character of the market. I didn't think we'd be moving sideways this long, and we could still make a new high. But look at this. First rally failed at the maximum fib level, near 88.6. This time 78.6, and this time 78.6 again. So we'll see what happens. I think it's going to be a lot of it's going to be according to the NFP, and VIX is coming in a little stronger today. Hi, Alexander, Jamie, hello to Colombia. So we'll see what happens there. Looking at the oil, it's pretty ugly, but we're back at some support from the last break. Be interesting to know if this looks pretty impulsive compared to this. Wouldn't be surprised to get some kind of bounce, but when you look at the oil, it looks vulnerable to me. And even though this looks like a three-wave drop, ABC, maybe we're going to get another ABC from here to take us down towards 59. So keep an eye on that. EG is trying to hold prior lows right here, almost a full-blown retest that we have, trying to reverse. If you're long, you could probably give it a shot and have stops under the lows. See if we get some type of reversal day to the upside. And you have to kind of hand it to Aussie. Kiwi's even stronger. They've been outperforming the European currency. So I'm going to kick it over to Ryan and see what he thinks. Ryan, we're getting a nice little pop in the gold market here and silver. Any feel on the precious metals? Okay, you're strongly neutral. If I kick it over to Stelios, I get a reaction here.
Good morning. Hey,
Ryan's
unmuted, but we can't hear him.
Yeah, we can't hear Ryan.
Hello.
Oh, we can hear you now. We can hear you now. There you go.
Hi, Ryan.
Hi, guys. You all right?
Yeah. How you doing, buddy?
Yeah, not too bad, mate. Not too bad. Seems to be a lot of technical problems going on today for some reason. Just in various websites and bits and bobs.
Okay. So any view on anything happening over in Europe that here in the States we might want to be aware of in today's session?
Yeah, a couple of things going on. We had the raft of services PMIs out, which were fairly solid. A lot of them were final readings, which dipped a tiny bit. But on the whole, just reading the reports underneath them, the future looks pretty good for the Eurozone at the moment. There's strong demand. Prices evident still that there may not be transitory. That was one of the themes coming out. We saw a bit of a dip in the euro earlier, pretty much after the PMIs. Not sure what that was all about. Looked like an order going through. And as you guys from the States are coming on board, we're seeing yet again, this is the third day on the trot, a sell-off in oil alongside sell-off in bond yields. I don't know if someone's doing an oil bond spread or something like that, but this is the third day on the trot we've seen a sharp move in oil and yields. So not sure what's going on there.
Yeah, I guess a little bit of deflation, some type of, at least a pause. I've talked to some people who said, now that the whole world embraced the inflation scenario, that we were going to have a pause for, maybe into the fall or so. And doesn't look like the metals are pausing at all today.
No, that's possible. But if you look at like a short-term chart of oil, 15-minute chart, it's pretty clear. Around about this time, the last 3 days, we've had these sell-offs. You can see those candles there, and do the same. Go back. Can you open it up a tiny bit more? Just enlarge it. You'll see the one going back to. There we go as well. So that's 3 days we're seeing there.
Yeah. And
the same move, pretty much the same pattern in bond yields as well. So they've dropped this morning from 1.18 in 10s to 1.15 at the moment. So looks like some sort of trades going through each time. Could be a model or something.
Yeah, so far we haven't taken out the 113 low on yields. We'll see. I thought that maybe the bonds could have one more push to new highs, but these aren't the highs of the move, so you have to keep that in mind. It's really, what could be considered a bear market rally after the big break that we had after COVID. I mean, not many people thought that we would take out this COVID crash low. It's one of the only markets to take out the COVID crash low on the board. And now we're back into this major resistance zone up here around 154. So it's going to be an interesting, are we starting to get some whisper numbers on the NFP that you're hearing, or what the market's looking for? Too early?
Yeah, a bit too early. Probably want to get the ADP out the way, because any whisper numbers that happen now are going to be, changed after ADP.
Yeah, ADP is becoming as important or as the NFP lately, isn't it?
It is, but the correlation is pretty crappy. I mean, every month everyone looks at ADP as a precursor for the NFP, and the amount of times it's missed or been different. But gives us something to trade, doesn't it?
Yeah. Well,
the best one is the Canada ADP. Their jobs one. Oh, it's absolutely atrocious. They give a flash reading for the next month, which might be up 200K, and then when that month comes around, it'll be down 400.
Interesting.
Hilarious.
Yeah. So, I mean, I look at the euro right here, and I'll bring Blake in. Doesn't this look like some type of flag that's developing here, Blake? I mean, we had this first run, got through resistance, and really all we've done is move sideways, and euro looks constructive to me.
I only see bearish moves in euro, so whatever develops bullish, I just ignore. I'm just kidding.
I know.
I'm joking. No, as far as the euro goes, I'm really not. I mean, you could look at that and say, maybe we're developing a bull flag pattern, which I think is possible, as long as we stay above the 118.50 level. So, and I've been looking at 118.50 as being support. Key resistance at 119, and maybe the ADP is what moves the needle. And by the way, good morning, guys, and good morning, Ryan. How are you?
Yeah, morning, Blake. You all right?
Yeah, I'm good. Well, yeah, I'm good. I'm as good as I get it at this time in the morning. So, so we do have, real quick, and I'm gonna take over really fast, Dale, and I'll just
go ahead,
reference what I was.
You were right when you said sell copper when I was bringing it up last week.
Hey,
came down very
that was more of a tongue-in-cheek type of thing,
Yeah,
but
I know.
hey,
Good call, tongue in cheek.
hey, whatever works. So sometimes luck is a great skill to have.
I'm
in
not
the
against
markets.
it.
Nope, me neither. A little bit of luck goes a long way. So what you're talking about here is like a bull flag pattern, and this being the flag pole. And what you'll notice here, and this is why I said 118.50 is like right around this level, right around this. Oh, it's 118.40, but you get the picture here.
Yeah.
We've been looking at 118.50 for the last, well, let me go double check that. 118.30. So, I mean, these are all really, really important support levels as we come into a really important week. And it's not just ADP, it's also ISM. But before I talk about all that data that's coming out this week, because we have ADP in 4 minutes, if you guys have not read about the NFP competition, make sure you guys get involved.
Oh,
Forex Analytix just tweeted our house account just tweeted the details to Ryan's post. So make sure you jump on Ryan's post. And Ryan, you want to talk a little bit about this really quick?
Yeah, it's just a fun competition that we're running. Guess the non-farm payrolls number on Friday, and we're going to have 2 winners, and those winners who get closest to the number are going to win a free month each on the platform.
Yeah, so I mean, and this doesn't prevent those of you guys that are already members, or you're part of the Forex Analytics community or Forex Flow community. If you guys win, we just tack that on to that extra month onto your account. So anybody can win, and everybody can win. I already put in my guess. I'm coming.
Yeah,
I'm coming in sub the headline number. What?
I'm going low 385.
I said next month is going to be. I'm going to come in higher. I think we're going to see a surge in job creation over the next couple of months, but I think this month might be a little light. What do you think, Ryan?
Yeah, I think we have to do a league table of the folks at Forex Analytics. I've noticed Dale hasn't put his on yet, so they're all hiding. They're all scared.
I'm
calling it on. I'm calling it on.
Look, I'm actually typing to our guys right now.
Yeah, get them on. Get them on.
So what do you think
in-house
about
competition?
Today?
Regarding ADP or?
Yeah, for ADP. Well, we're looking for 695,000 jobs. That's a forecast. It's basically the same as last month. And let me ask you this: do you think it's going to be a market moving event?
It will be if it's wild. If it comes in something like
an outsized type of number.
Yeah, look, probably you're looking at 300k either side. You're going to get a move because, as I say, all the economists, they're sitting there with their Tipex and their razors, and whatever happens here, they'll be changing their NFP calls. We'll get the flood of that coming out. NFP's I think about 880 expected this month, just off the top of my head. I'm sorry,
for
NFP, yeah.
NFP, I think we're looking for 850,000, something like that. Yeah, 850, 875, somewhere around. I know there's a couple different estimates running around, but yeah, over 800K.
Yeah, 880 on Reuters at the moment. So yeah, we'll get all the economists, join things up. But the thing is, how much is it going to mean for the dollar? I mean, we've had pretty much good jobs reports. Last one was obviously quite good. It was the one before that was a bit softer, but it was still 500 odd K, 560, something like that.
Yeah,
and
actually the last one was. Are you talking about? I'm sorry. Go ahead. Just continue on.
Yeah. So the last one was 850. The one before that, I think, was the one where everyone was expecting 2 million or something. It came up at 560 or something like that. So a lot of expectations. But I think that what the Fed are looking at is this big divide between the amount of vacancies and the amount of unemployed, because you've got 9 million vacancies, give or take, and you've got 7.5 million still unemployed, as they say. So that ratio needs to come in before the Fed really take notice. Right, 5 seconds to go.
Number. Yeah.
Yep. Okay, I voted.
330.
But I voted too.
330.
Look at that. Wow. Hey, you know what? My NFP guess this year might actually be, or this month might actually be spot on.
Yeah, well,
575. Look at that. Look at that.
I
Look
went
at
for the
dollar.
number of the beast, 666.
Oh, did you? Well, hey, at least you're in.
Hey, I'm a big Iron Maiden fan. Okay, that's why.
Is that the reason?
That's fine
why?
by me.
Okay. So, you know, here, this is interesting. We had a strong employment data out of New Zealand yesterday, and everybody's that's been watching the Morning Edge webinar that happens in about exactly 1 hour from right now. Everybody that watches the Morning Edge webinar, I tell them every day, don't be bearish to Kiwi. I am not bearish to Kiwi. And, you know, it gave us a false breakdown and we're rallying. Now you just added fuel to the fire, putting on some weak ADP data. And so dollars out there getting crushed right now. So, you know, I don't know. This doesn't speak well for you know, tapering. So what do you guys think? And by the way, good morning, Stelios. What do you guys think here? I mean, weak data is just good for stocks. That's the way we have to look at it.
Good morning, everybody. I agree, Blake. And I think central banks want to find excuses not to taper or to be more dovish. So this is fueling that, and stocks are going to like it. Yields are dropping. I'm waiting very patiently. Remember, guys, when I closed my Bund shorts, 169 and change, and I said I'm waiting for the descending trend line, which is like a 2-year trend line, which comes in at around 180
on the Bund.
On the Bund, yeah, 178 and a bit, and we were at 169, 170, and I said, you know, I'm going to wait for that. If you go further back to 2019, late 2019.
I don't have it here. I'll have to go pull up a different.
Anyway, don't worry. Oh, you have it there. Look, you have those 3 spikes there. 1, 2, 3. Anyway, don't worry. Anyway, it comes in around 178 and change. I'm going to start shorting 178.
I got it. You're talking this.
I'm talking about the I'm talking about the high from August 2019. It's just to the left. There you go. That one, then the next one, then the next one, and it's wait a minute. That's weird. I don't have that spike up there. Maybe we're looking at a different
instrument.
Yeah, it's a different instrument. Oh, you're looking at D10Y. Yeah. I'm looking at the Bund. Just the Bund.
Oh, got it. Okay.
Anyway, it doesn't matter. It's similar. If you take away that spike, it's similar. And I've been waiting very patiently for some time now for 178. I think we're going to get it, and that's where I'm going to start shorting again. But you know, to answer your question, bad numbers obviously not helping the whole tapering and hiking unless you're, you know, Norway or countries who are actually going to do something. But the Fed is kind of in the corner. You know, they're in the corner. They still have high inflation. PMIs are still, you know, coming up at well inside expansionary levels, and I don't see how inflation is going to drop within the next 2-3 months. There was one of the Fed members, who was it yesterday, who said, we think it's going to be until something like September, October. You know, they actually put a number to it, to when they think the inflation is going to start dropping, and, you know, given their assumptions, basically. So we have an idea now when to start panicking. So I doubt that we're going to see inflation come back down this quickly. Not this year, I don't think. But obviously, we'll have to see.
Was you know, talking about like maybe, you know, higher inflation is obviously we've had this conversation a lot over the last couple of all we talk about, it seems like these days, is just inflation. And one of our, you know, favorite inflation hedges as far as you know, instruments go, you've got gold and silver that are now starting to perk up, and actually you got silver challenging. Actually, this is if you go again, I'm just going to reference our bias chart. I don't think there's been a day in the last week and a half that we haven't written down 25.90 or 26. You guys have to go. Those of you that are Forex Analytix subscribers know that this has been channel resistance for us for the last, you know, couple of weeks, and we're up at basically channel resistance right now. I mean, we're spiking higher in silver, gold spiking higher too, up into range highs. And by the way, this is a range breakout. Just if gold breaks 1835 or it breaks below 1790, you play the breakout versus assuming which way it's going to go. I know a lot of people like to assume because they're, so smart and they've been trading the markets for as long as they have that they can outsmart the market. So they just assume they know which way the market's going to go. But in a case like gold, I mean, we've basically been range bound for the last month and a half or month and a week. Let the market do the work for you. You don't have to be smarter than the market in this case, and especially when you got a big triangle developing. What's that?
Looks like an ascending triangle.
Well, I have it as
I'm
marking it as more of a symmetrical triangle. My biggest problem that I have with gold, and our normal listeners will know this, is that if inflation is such a big issue, why hasn't gold been a bigger mover as of the last year? And I've actually had conversations with Bill Baruch at Blue Line Capital, the owner of that brokerage firm in Chicago.
Blue Line Futures. Yeah.
Blue Line Futures, excuse me. Thank you. I've had conversations with him. We've done interviews about this, and I really am worried about gold just not really being very responsive. Now, maybe it'll play catch up sooner or later, but maybe it's just it's also very strongly inverted to the dollar. And I mean, we can't, no one can argue that the dollar hasn't held up well in this environment, because it actually has done quite well based on what we've seen. So I don't know. We don't have to make the case for gold right at this moment in time, but I will tell you that I think it is, in a triangle, and it's symmetrical, right? And it might be symmetrical. Excuse me. This one is an assumption, but we are going to get up towards that the upper end of this potentially potential triangle, and then we'll see what happens from there. But they are on the move this morning. Now, Ryan, you mentioned that that crude oil has been rolling over, and it's rolled over quite hard the last couple of days. And if you were listening on the F.A.C.E webinar yesterday, we had on our Morning Edge webinar, this bear flag pattern completed yesterday, and you can see it completed perfectly. I'll take you over to an hourly. We were talking about that. We're like, okay, it should stop right here. It did, and then obviously this is overnight until European trade. But how do you guys feel about crude oil here?
Yeah, I'm not sure what's going on here. As I mentioned to Dale, if you've got these three candles now, or these three moves that have happened roughly the same time every day, 3 days on the trot. It's coincided also with a drop in bond yields. So it looks like that there's some sort of big trade going through. That's, take away the fundamental side of things. When you see moves on the clock like this, it always stands out, and you've got to think that there's something going on behind the scenes. We never get to hear about it till after the event. Might hear next week that such and such bank or fund was put through a load of sell contracts or something. But it's a strange move. I mean, we've got the underlying current, as Dale mentioned, about possible slowing down, stagflation, all that sort of thing. That's the underlying current that seems to be flowing through bonds and commodities and growth expectations and so on. So that is still there. And is it going to change soon? It's not going to change from a central bank point of view. Looking at the ADP just now, but just quickly on that, I want to mention regarding ADP. The market's probably going to go, oh, that's going to kick the Fed back, and lower for longer and all that sort of stuff.
And just to mention that I mentioned that too, and I was like, stocks probably are going to get a lift from this, but actually S&Ps are at their lows. So sorry, continue on. I just wanted to point that out.
What I was going to say is that although it's a big miss, 300,000.
Yeah,
it's still a positive number, and in normal times 330 would be a big number.
That's true. Again, it's a good point.
And I'm looking at the report. There's only one sector in the ADP that was down, and that was information, and that was down 1,000 jobs. So it's still a positive report. that's making it a trend of positive reports that we've seen. Okay, it's not over the 500k mark that many people might expect, but it's still a plus number. And as long as that trend continues, all that's going to do is keep things positive for the Fed. It just might change the length of their timeline, how long they taper for, and when they announce it. But I don't think that's going to change. That's going to happen towards the end of the year. We're going to get a decision one way or the other. And as I said just before the ADP, we've still got this ratio to narrow between the jobless that are still out there and the vacancies that are growing month by month. And until that gap closes, then you're not going to see much go on the jobs as far as the Fed's concerned.
As long as you're incentivizing people not to work, that's going to take some time to close.
Exactly. Got to take that away.
That's been, so I know I was talking to Jim Welsh from Macro Tides regarding this, a couple of weeks back. Many states have retired that program. So you're going to see people going back to work, I think, over the next couple of months. So I guess, the question that we all are still asking is, November, December, or January, when is the tapering going to start? What's the pace of it going to be? And I think those are still questions that, need answers and the market's going to be looking for. I want to point out that yesterday the S&P hit, and again, I'm going to reference this bias chart. We do this every morning on the morning edge that is for Forex Analytics subscribers only. We also do the daily roundup and European crossover, a lot of webinars that are specifically for Forex Analytics clients personally or privately, excuse me. But the 43.75 level has been a level of support that we've drawn since here. Since we broke into new highs above that 4,400, we're like, okay, as long as we stay above this previous support, which was hourly support, that's going to be it. And that has held as support for literally the last, couple weeks now. And so the reason why this is so important is because this is almost, I want to say the line in the sand for the market is really the wedge support, which comes in around 4,300. But really, bulls right now are hanging their hat on that number. And it took us almost to all-time highs yesterday after that, respecting that number. And I think this is going to be the number that we all should be focused on going into the jobs report on Friday. I don't know if we're going to actually break that number, pre-jobs report over the next couple of days, but that is obviously what the market's looking at. So if there's anything that you can take away from today, write down S&P, 43.75 and just put an asterisk next to it, put an alarm on it, and sit on that number for a while, because I think that's going to be really important going forward.
I love patterns like that. That to me is just gold. You get in across a good decent period of time, a couple of weeks, like you say, you're getting solid support showing up. On the top side, you're getting solid resistance. I'm actually going to go away from here and I'm going to look to plot some buy stops and sell stops just on either side of that range, because it just looks juicy.
And I think that makes a lot of sense, because look, we surged through these highs. We're probably going to see the upper end of this wedge, which will be the 161% extension. So, you can say, well, on an upside breakout, which is entirely possible, give us some porridge that's not too hot, not too cold, that's just right. You give us a jobs number that's really not super hot, but it's not super cold. If it's just right, we're going to be sitting up here by the end of the week. Flip side to that is, some porridge. You guys get where I get that reference from. Am I too old?
Depends what you mean.
I'm using
porridge in the UK means jail time.
Oh no! I'm talking about the three bears, little three bears. Porridge.
Oh, okay, yeah.
You guys,
they got killed on the S&P rally.
Is that what? Is that what it is? I'm thinking
three little bears. They're gone, man.
As I approach 50 years old this year, that I'm too old for this, and I'm saying kids rhymes. Anyway,
all right, wrap it up, Gramps.
Sorry. All right. So the support might take us back down. Breakthrough support will take us down to 4,300. So I'm going to leave you guys with a couple things. And I heard Steve pop in a little earlier. Steve, good morning. We'll see you on the. Everybody's excited to have you back and have you back on the morning edge. Stelios, have a great one. Ryan, thanks for joining us today. Don't forget,
Cheers, guys.
our non-farm payroll competition. It's on the Forex Flow. Here it's the Forex Flow tweet. I think I retweeted it. But anyway, make sure you follow Ryan. So he's running that competition. You get a free month of Forex Analytix. Also, guys, don't forget that we have a special pricing that's in place because of the merger between Forex Analytix and Forex Flow. So you're buy 1 month, get 1 month free, semi-annual, annual subscriptions. We haven't run a discount since the beginning of the year. So it's been almost 8 months since you got an ability to get Forex Analytix at a discounted amount. So take advantage of that because of the merger of Forex Analytix and Forex Flow. And I want to say, Dale, have a great interview with Peter. Peter is one of my more favorite people, that I've listened to over the last, 20 some odd years of watching, 25 years of watching financial news on the boob tube, so I always enjoy listening to Peter. So you guys are in for a great interview today. So welcome Peter Bookvart, and give him a warm welcome with Dale. So thanks, Dale.
You're welcome, Blake.
All right.
Cheers, guys.
All right.
See you
All
guys.
right. Good hunting, everyone. Hello, Peter. I'm trying to make you a panelist. For some reason, it's not letting me, so I'm just going to allow you to talk. Peter, how are you?
Can you hear me?
I got you, buddy.
Oh, some kind words. I appreciate what your guest just said.
Yeah, that's Blake. You have a lot of fans here, Peter. What's the NFP going to be in light of what we just saw from the ADP? What do you think?
Well, it's not a good thing to draw a line between ADP and BLS on a monthly basis.
Okay.
But I think that the ADP number was certainly a reminder that there is an issue with the supply of labor. There is not an issue with the demand for them, as seen in the level of job openings. So no doubt that there is now risk to the downside in this number following this report. But again, we've seen plenty of months of offsides between ADP and BLS. So I'm not going to jump to any conclusions just yet.
Okay. Well, then why don't we talk about some of the things that you've been writing on your website, Peter? First of all, it's interesting, I've talked to someone who served in different administrations, and he was on with me about a month ago, and he said that I read your writings that you also believe that Brainerd is going to be the next Fed chairman, and that
the possible next. I still think that Powell has a shot because there's a lot of politicking that's going on behind the scenes here that Powell can easily get reappointed.
Yeah, I've heard people say at this stage of this economic recovery wouldn't be such a great idea to change Fed chairmen. Do you have a view on that?
That's a possibility. You also have to deal with the political and personal dynamics between Janet Yellen and Brainerd, if she is it, because they're going to work closely together. Obviously, Yellen knows what she's getting with Powell, even though she knows what she's getting with Brainerd too, because they were on the committee together. That dynamic is in play here.
She's a little more progressive, but I mean, Paul has definitely fallen in line with. He knows.
Oh, they're all the same thought, no doubt. So, but
same cloth, right?
Yeah, but I just think that that they're just also political and personal considerations here as well. So I wouldn't be surprised if Powell is reappointed, and I wouldn't be surprised if he handed the keys to Brainerd.
Does this remind you of the 70s, strangest landscape I've seen in a long time, Peter, with job openings and people, not wanting to go back to them, and, all the artificial stimulus and payments, entitlements. Delta has reared its head a little bit. Have you ever seen anything like this? Are we in stagflation already? What do you think?
We are in stagflation, certainly in particular sectors. All you do is look at the housing industry, and that's just the perfect example where you've had house
Yeah.
price inflation being so aggressive that it is now creating sticker shock for a lot of potential buyers, particularly the first-time buyer. And that then in turn slows the pace of transactions. Then you throw in also, of course, you have a problem with the supply of product
Yeah.
because builders can't find enough lots or find enough materials or labor to build those homes, which then exaggerates the supply constraints, which then further increases prices and therefore turns off potential buyers, particularly that first-time buyer. And that first-time buyer is a very important piece of the housing chain, because when you think about the trade-up buyer needs a first-time buyer to sell their home to, and if they can't sell that first-time buyer, then they're not moving up to a bigger home. So there's a variety of problems that this creates. And of course, you shift to the auto sector. Yes, you have a shortage of semis, which then leads to a spike in used car prices, a rise in new cars, and then you reach a point where buyers are saying, "Oh my God, I can't believe I got to pay this for a car," and that slows things down. In the ADP number talked about earlier, you can't get enough workers. That leads to a more elevated level of unemployment. At the same time, you have all these inflation pressures. So it's definitely a form of stagflation, which then just creates an even bigger problem for the Fed, because they're not going to know what to respond to. Now, we know that they're focused more on the jobs data. So you talked about what are the comparisons to the 70s. Well, Arthur Burns was the chairman of the Fed from 1970 to 1978 or 79 when Volcker came over, and Powell seems pretty intent on being the next Arthur Burns.
Okay. And, that's a lot of things happened. Bretton Woods was the end of that. A lot of things happened in the 70s. I'm wondering if you could explain to me and tell me if there's any significance and if it's isolated with just Wells Fargo about them pulling personal credit lines from people.
I did see that, and I don't know what went into that decision, because there are plenty of other banks and other financial institutions where you can get credit lines. So I don't know what the aggregate.
It might be Wells Fargo specific. How about what's happening with the problem of too much liquidity for the banks and all these reverse repos, kind of breaking records with reverse repos, and the Fed backstopping some type of money market fund for the banks? Can you explain what the problem is about banks having too much liquidity?
Well, it's just the symptom of the Fed just way overdoing it, and shoving reserves down the throats of the banks, that then it ends up back at the Fed in reserves. I mean, that's the craziness of QE, is that it sort of drugged these central bankers into believing that it's economically stimulative, which is no empirical data whatsoever that it is. So they give banks the cash, they take the bonds off the market, and then basically they shovel the bonds right back out in these reverse repos. I mean, it's just a game of whack-a-mole is what this is. But the problem with debating this and discussing it is that the Fed thinks that QE is economically stimulative, even though it's not, and then they have to deal with all the unintended consequences of this overload of liquidity through these, alphabet soup of different facilities.
Okay, we've had a real. I thought a week or so ago when we put this low in, Peter, if you could see my 10-year yield chart, I thought that might be it, and we're kind of getting a retest here. Any view on yields? We had this real nice move up to me, it could still just be corrective, this decline in yields. You think we're going for 1% or?
I don't know. I mean, I'm in the belief that inflation is sustainable and persistent,
Right.
which would obviously be negative for bonds. But on the other hand, a lot of this curve's flattening and the leg down in yields came in the middle of June when the Fed said that they're beginning to talk about tapering. Because when you look at each
Okay.
of the episodes of QE, when it was on, when it was off, when QE was on, the curve steepened. When QE was off, or was tapered, the yield curve flattened. So that's when you started to see the flattening. And then you throw in, of course, Delta variant, and then the growth worries that inflation is now causing, because higher inflation is now causing a slowdown in growth, both in real terms at the GDP level, but also real wages. And obviously, growth slows just naturally if you can't get stuff. So that's why we're seeing the drop in yields. But there is a tug of war between the inflation story on one hand and the growth slowdown we're seeing on the other. The net result is stagflation, and there'll be some days when the long end is going to respond to these higher inflation prints, because we're going to still see a slew of higher inflation prints in the months to come. Because any moderation we see in the pace of goods inflation, which maybe we see in used cars, but I think will be offset by others, is we are about to see in the CPI and PCE data a sharp increase in the pace of rental increases. We're seeing apartment list national report for July, which came out last week, which is showing massive increases in rents. So CPI is showing like 0.2 to 0.3 increases in month-over-month rents. Apartment list is saying they're going up 2% per month, month-over-month. In fact, their July report said that from June to July, rents went up 2.5% just in the month, and that year-to-date, rents are up 11.4%. Just year-to-date.
It's going to be a revolution, Peter.
So, that's 40%.
Yeah,
of course CPI. That's 40% of core CPI. So if you show me a decline in used car prices or softening and a drop in lumber prices, I'll show you rents and I'll show you a 10-year high in the CRB Raw Industrials Index.
Well, if you build some type of wooden bed in your car, you're okay.
Right.
Could live there, right, Peter? I mean, this squeeze on the middle class is unbelievable. I mean, these prices, if you're very affluent, it's like water. Money's like water anyway, just keeps flowing. But, what's going to be the outcome with people being squeezed? I'm trying to remember the 70s. I was having too much fun to remember it, but I was in the business and I remember the win button. Remember that, Peter? Whip inflation now.
Yep, I was a kid, but yes.
Yeah. So I don't know what the button's going to be for this. What do you think of what's happening with this Delta variant? You said we'd be able to go to a concert this summer, and Lollapalooza in Chicago is definitely a big concert. A lot of people, next to each other. Do you think the efficacy of these vaccines, which drop sharply after about 6 months, is going to be a problem this fall?
I don't actually. I think we power through this.
Okay, cool.
I said for two reasons. Number one, we have no choice. We're not shutting down again. It's just not happening. And number two, I do think that they're gonna, while maybe they'll see a lower level of efficacy, it'll still be rather high. And if you look at the data, not anything else, 99% of the people that are being hospitalized haven't been vaccinated. Okay. So if you look at those numbers, that's the fact. Also, the faster Delta spreads, the faster we're going to get to some level of herd immunity, because you're going to tack that on to people that have already had COVID, plus the vaccines. So just look at India a few months ago. The numbers skyrocketed and then came crashing down. Look at the numbers in the UK. They continue to fall. There is a level of herd immunity out there. The problem is not necessarily Europe that has high vaccination rates in the US, but it's Asia, where outside of China and maybe Singapore, there's been low levels of vaccination rates. And that's where you're seeing a problem. Now, Japan I'm sure the next 2 months is going to really ramp up vaccinations. But Thailand, I think only 5% of the people have been vaccinated. COVID's ripping through Indonesia. But on the other hand, again, not to be callous with people getting hurt by this, but there will be. That's one of the benefits of a fast-moving virus is you're going to get to a level of herd immunity or natural immunity much quicker.
Okay. We've seen a little pressure in some of the commodity markets. Once everyone did embracing, the inflation scenario, you have copper coming off, you have more like the economically sensitive commodities, copper and oil. Oil's come off. Do you attribute that to just a little bit of a COVID scare in Asia, taking a little bit off GDP world growth and not as much demand?
Yeah, I believe so. I think definitely Asia will see a slower pace of growth. But on the other hand, I mentioned the CRB World Industrials Index traded down yesterday, but Monday's close was at a 10-year high. And the reason why I bring that up, and then I like to look at this particular index, is because it includes things that aren't traded on futures exchanges, which are obviously.
You know the symbol of it, Peter?
On my Bloomberg, it's CRB space RIND, Robert Isaac Nancy David. So it has tallow in it. It has hides. It's got resin. So you're not trading futures on that. Whereas and which show that it would better reflect pure supply and demand as opposed to speculator emotion in the copper or oil market.
Okay.
But what's going to keep commodities elevated for a while is just the lack of investment, particularly in energy. I mean, we heard from BP and Royal Dutch and Chevron and Exxon and Conoco over the past week. None of these companies are aggressively investing in the business. They're just basically trying to maintain their current exploration projects, maybe adding small ones here and there. So, yeah, maybe we see a drop off on the demand side, but you are not going to find any major supply increases, certainly in the non-OPEC world, of note. And if anything, shale is going to remain well below its production levels of 2019. So I would be buying any sharp commodity pullback that if we do get it.
You still like metals, right?
I love precious metals. It's been maddeningly frustrating, particularly this year when, while they had a great 2020 with silver up about 40% and gold up 25%, the backdrop has played out pretty well with the inflation story, the drop in real rates to record lows. Now the dollar, of course, is up, so that's been a slight headwind, but the dollar is barely up. The dollar index has gone from 90 to 92. I don't call that much of a rally. So you'd think that with everything going on, gold and silver will be much higher, but they're not. They're down in the year. So it's been a frustrating year being bullish on it, but I remain so. I still think that the bull market is intact. And people are going to realize that not only will the Fed go really slow with this taper, if they even get it off the ground, because you still have plenty of doves out there, but even if it takes them a year, rates are still going to be at zero. And if I'm right on inflation, real yields will still remain deeply negative.
Speaking of bull markets, Peter, is there ever an end to this bull market? S&Ps?
Yeah, I think a lot will depend on this inflation story, just because it's something that no one really has any experience with. The 1970s.
So would higher yields be the pin that pops it?
Well, I don't know if it'll be higher yields or it will have to be the Fed's response to it.
Okay.
And yeah, because if the Fed does start to taper because they have no choice, because the inflation stats remain high, then we know, looking back over the last 10 plus years, the stock market doesn't like a tightening. We corrected after QE1. We corrected after QE2. There was a correction. We had the taper tantrum. And then when QE3 was tapering off, we had a correction then. We had a correction in the 2 months following the first rate hike in December 2015. We remember January, February 2016, we sold off. We had a sell-off when Powell was pushing it with rate hikes in the fourth quarter of 2018. So there is that's when you have every correction of note has taken place outside of COVID, of course, has taken place when the Fed has been walking in the other direction. And if the Fed is about to start walking in the other direction, that is a setup for a correction in the markets.
Could it be that easy though, Peter, that people could just wait for the bell to ring?
Well, look how easy it was on the flip side. Whenever the Feds started easing, it was close your eyes and buy stocks.
Right.
And March 2020 was the perfect example of that last year when the Fed said they're going to start buying corporate bonds in addition to cutting rates to zero and doing massive QE. Well, it was time to buy stocks.
Right.
So, unfortunately, it has been that easy.
I'm just so skeptical about, all you have to do is wait for one thing. But, going back to Marty Zweig, I guess it is a key. And no one's going to change. And, maybe people don't even change right away on that. We get initial market reaction and they say the market could handle it because the Fed has prepared the ground for it over
we always
6
hear
months.
that. We always hear, rates are going up because that's a good thing because that means the economy's getting better. Oh, the Fed's tightening. Oh, that's a good thing because the economy's getting better. Happens every single time, but that is the initial reaction. And then, of course, something breaks and that changes.
Okay. Anything you want to wrap it with, Peter? It's really great to catch up with you.
And
what's the number one thing on your mind?
It's this inflation story. If it has legs and if it is persistent and sustainable, the Fed's going to have a big problem. And as is the economy, because the economy is not set up. The world's economy is not set up for higher inflation of persistence. The world's level of interest rates is not set up for that. Yesterday, we closed with $16.5 trillion of negative yielding bonds. That is not prepared for persistent inflation. So it all is about inflation and where it goes from here.
Okay, we're going to wrap it on that, and inflation being the key, and not necessarily yields on their own, but the Fed ringing the bell.
Yes.
Thank you so much, Peter. Really great to hear your voice and catch up with you. And
same here. Thanks, Dale.
I encourage people to go to Peter's website. He does have free access to some great research, and you could follow him on Twitter at pbookvar. And I always turn the volume up when you're on CNBC, Peter.
I appreciate that. Thanks so much, Dale.
All right, buddy.
All right,
so that's a wrap, everyone. Peter Bookvar. Inflation. That's what undoes what's been happening since 2008. So keep an eye out for the bell to ring by the Fed. And looks like Peter also thinks that Brainerd is a possibility for the next Fed chair. And I appreciate everyone paying attention and hanging out with us. That's going to be a wrap. Good hunting the rest of the day. You could join the team in about 17 minutes, 22 minutes for the morning edge. And don't just count your inflation hedges, count your blessings, and we'll see you all tomorrow. Adios.